A lot of those iron ore plays on our market have had a pretty tough week. We're seeing that spot price falling into bear market territory below 130 US a tonne. What's been driving this?
Liz, we've actually seen iron ore prices drop to 125 US a tonne, and that's a drop of more than 20% now from the peak that we saw of $160 in February. If we have a look at the iron ore price just over the last 6 months, this is what it looks like. You can see we saw that $160 back in February, and since then we have seen a tumble in iron ore prices. If we have a look at steel production though, steel production from China has been holding up fairly well. We have a look at the daily crude steel output. We have seen it remain above 2 million tonnes per day since around about mid-February. And in fact, in April, we even saw a record of 2.13 million tonnes. So steel output has been holding up fairly well. However, this usually does peak in around the second quarter, which we're in at the moment, and then we see some seasonal weakness creeping in the third quarter. So it doesn't look like it's the steel production side which is driving down iron ore prices. But if we have a look at trading activity of iron ore, this is where things get quite interesting. Now, Reuters was talking to some steel traders, and they said that there's been 2 to 3 million tonnes being resold into the market this week. Now, it's not unusual for steel mills to be selling iron ore into the market. In fact, a lot of steel mills have trading units, but it's the volume that's happening at the moment which does imply that we may see short-term production cuts occurring. Some steel mills do sell their long-term contract prices back into the spot market, only to buy back at port later. And what this does is it saves them storage costs. But it does look like the volumes that we're seeing in terms of trading activity, implying that we may see some short-term production cuts coming through from Chinese steel mills. So we have seen iron ore prices take a pretty big tumble. In fact, since prices peaked on the 20th of February, we've seen our iron ore plays falling quite steeply. Of course, we look at Rio Tinto when we look at iron ore, and if we just compare Rio Tinto's share price to iron ore prices, I've got the iron ore prices on top and Rio Tinto's price down the bottom, and you can see that Rio Tinto's share price pretty much moves lockstep in barrel with the iron ore price. Other players like Fortescue and Atlas are more leveraged to the iron ore price than Rio Tinto, so we've seen steeper falls. Rio Tinto has really tracked that fall in iron ore prices, and it's down 22% since the peak that we saw in February. But if we have a look at Fortescue, that stock is down by 35% since the February peak that we saw in iron ore prices. And Atlas Iron, it's even more leveraged. It's down by about 53%. So unfortunately, the iron ore play is having a hard time on the Aussie share market, really being driven by the weakness that we're seeing in the iron ore space. And a lot of that seems to be around trading activity, which implies short-term production cuts.
On a brighter note, Julia, offshore revenue makers have really been the winners this week. Thanks to the strength of the US dollar, we've seen the likes of CSL, Brambles, QBE, all making some great gains. Do you think it can continue though?
Absolutely. We have seen those companies which do make a lot of their revenue offshore being the big winners for the week, and certainly outperforming the Australian share market, which has seen a fall of 0.8% for the week. All this, of course, is being driven by that weaker Australian dollar, and we've actually seen a fall of 2% for the Aussie dollar against the US currency this week, and traders do seem to be favouring shorting the Aussie dollar and buying into the US currency. That's been good news for a few stocks. We've seen ResMed up by 1% in the healthcare space. In the industrial space, we've seen Brambles gaining 1.4%. We've also seen News Corporation up by 2.1%. Westfield has gained 2.3%, and we've also seen QBE Insurance up by 3.4%. So as long as that weakness in the Aussie dollar continues, these stocks are likely to benefit. If we have a look at that weaker Aussie dollar, though, it also signifies a tumble that we've seen in commodity prices. So unfortunately, the other side of the equation is that the commodity-based stocks haven't been faring so well this week. The material space is down by 4.3%, and the industrial sector has managed a loss of 2.6%, really being driven by those mining services companies, which have come out with some hefty profit warnings this week. We've seen profit warnings coming out from Coffee, United Group. We've also seen Sedgman and Chandler McLeod all coming out with profit warnings this week, and really that's related to that mining space. So on one hand, that weaker Aussie dollar, good news for those stocks making revenue offshore. On the other hand, also reflecting weaker commodity prices, and unfortunately that hasn't been so good for the materials and the industrial space.
So what stocks are you going to be watching closely today? Do you expect that it's really going to be that defensive play again, considering we have been sort of seeking shelter with all the commodity price weakness that we have been seeing weighing on materials?
Absolutely. The biggest winners this week have been the defensive areas, and we're expecting that to continue on the market today, given that we did see Wall Street taking a breather overnight. It's been a record run for Wall Street this week, but overnight we did see a bit of a pullback in terms of prices. And if we have a look at what's happened, we've also seen inflation numbers out of the US down by 0.5%. So gold also taking a hit there. And remember, a lot of gold trades happening because of fears around inflation, but it does look like it's more disinflation, which is a concern in the marketplace. We did see copper prices up overnight. Before the week, it's actually a fall of around about 2%. Oil prices also bouncing back slightly overnight. But all in all, that weaker lead from Wall Street looks like it's going to be those defensive plays, which are once again in favour on the Aussie market.